right now, inflation is at its highest level in 40 years, and the rate is currently at 8%. Inflation essentially means there's more demand than supply, thus raising the prices. And to combat that, the Federal Reserve increased interest rates by 1/4 percentage point. That interest rate increase will make it more expensive to, say, take out a loan. The goal is to have fewer people borrow money to buy things and then reduce demand, thus lowering prices. However, an economics professor at Coastal Carolina explains raising the rates too fast could lead to a recession. So the Fed and markets are now walking a tightrope.
The markets and the Federal Reserve seem to be in agreement. That reduces uncertainty. So that could counter the effect of the coming recession.
Now, if spending decreases too quickly, Salvino says that government borrowing would pick up, which could add to the risk of recession. So with that effort to bring down the cost of living, will we at last see a slowdown in, say, the housing boom with mortgage rates now set to jump back up? ABC 15's Andrew James took that question to those in the real estate market today. He joins us now live in Horry County this evening with the answers he got. Andrew.
Yeah, Jim, well, already some of the nation's largest lenders for potential home buyers, they've followed the Federal Reserve, raising their mortgage rates to well above 4%. And some of those numbers we haven't really seen in roughly 3 years. But local agents, they tell me they're not sold that the change will actually slow down this runaway real estate market.
We've never really had a market like this.
A market that's shaping up to be one of the most expensive in Myrtle Beach's history for potential home buyers.
We see the same amount of demand, if not more, but we still struggle with severe lack of inventory in our market.
The latest numbers from the Coastal Carolina Realtors Association show average home prices jumping into the lower 300,000s for January and February. With the month's supply, that's the number of months homes are actually being listed and made available, it's again at a record low. But Jamie Broadhurst with a local Century 21 Realty is seeing a shift.
I've seen a little bit of a lull in the market in the last 30 days.
He says that because of uncertain economic conditions with record high inflation and conflict in Europe. But now there are interest rates, impacts that could trickle down to mortgage seekers.
Yesterday's announcement has already triggered the large banks to raise their rates.
But neither Broadhurst or Watermark Real Estate's Radha Herring see the rate hike leading to a market slump just yet.
I don't know if it will truly dissipate or reduce the demand for our marketplace.
And I just don't see it that as an issue slowing down the marketplace right now.
The rates and other factors like increased home inventory, constant inflation, Broadhurst agrees that over the next year or two, that's when we could see buyers and sellers make changes.
Now, if we hit 4 or 6 interest rate hikes in the next year to 2 years, that's going to be something that's going to cause people to make a little bit of a different decision.
Now, with more interest rate hikes on the horizon, per the Fed, there's one group that both Herring and Broadhurst agree is going to be disadvantaged through this. They're already disadvantaged, but even more, and that's first-time home buyers. But Herring says there's always still brighter pastures to look at in all this. To put this in perspective, seeing mortgage rates at 4 to 5% is nothing compared to what was being seen roughly 20 or 30 years ago. For now, live in Horry County, Andrew James, ABC 15 News.
Andrew, thank you. Now, the local Association of Realtors is forecasting the rest of the year will look much like 2021, but the factors like low home supply with those high prices and now increasing interest rates may slow things down just a bit.